In 1942, the United States Treasury quietly released over 300 million ounces of silver from its vaults, not to back currency, not to mint coins, but to wire the electromagnets that separated uranium isotopes for the Manhattan Project. Silver conducts electricity better than copper, and when a war effort needs every advantage it can get, cost stops being the deciding factor. That single fact tells you something most retail investors never think about. Silver is not just a monetary metal or a jewelry metal, it is a defense material. And once you understand that, a much bigger question starts to form. If silver is quietly essential to modern weapon systems, radar, guidance electronics, and munitions, does it serve certain interests to keep that metal cheap and unnoticed by the public? Before we go further, a quick note. This video is educational. We are walking through publicly documented history, known industrial uses of silver, and legitimate market structure questions that analysts have raised for years. Nothing here is financial advice, and nothing here should be treated as an accusation against any specific institution. Our job is to give you the framework so you can research and think about this for yourself. Let's start with why silver matters to defense in the first place. Modern militaries run on electronics. Every guided missile, every radar array, every satellite communication system, and every piece of night vision equipment depends on components that use silver somewhere in the circuitry, because silver has the highest electrical and thermal conductivity of any element. Copper is the cheaper substitute in consumer electronics, but in applications where performance cannot fail, silver is often the material of choice. Silver oxide batteries power precision equipment. Silver-based coatings appear in optics. Even small arms ammunition primers have historically used silver-based compounds in specialized manufacturing. None of this is speculative. It is documented in industry reports from organizations like the Silver Institute, which tracks industrial demand for the metal every year. Now, here is where it gets interesting. Defense budgets are enormous, and defense contractors operate on long procurement cycles, often locking in contracts years in advance. A sustained spike in raw material costs does not just affect a company's quarterly earnings. It can affect national procurement budgets, delay weapons programs, and create political headaches for governments trying to fund multi-year defense contracts. So the logical question an analyst might ask is this: does a stable, low silver price help large-scale industrial and defense buyers manage costs more predictably? That is a reasonable economic question. Whether it translates into deliberate price suppression by any specific actor is a separate and much harder claim to prove, and we need to be honest about that distinction as we go. This is where the story connects to something that already happened, not theory, but documented fact. In 1980, two brothers named Nelson Bunker Hunt and William Herbert Hunt attempted to corner the global silver market. They accumulated an enormous physical position, and by January of that year, silver prices had spiked from around $6 an ounce to nearly $50 an ounce in a matter of months. Then, in a sequence of events now studied in every commodities course, the exchanges changed the trading rules. Margin requirements were raised repeatedly, and new rules restricted buyers to liquidation-only trading. The price collapsed within days, wiping out the Hunt brothers' position and crashing silver back down. What's important here is not whether the Hunts were right or wrong to try cornering the market. What's important is that this event proves something markets don't like to admit. Exchange rules can be changed quickly when a price move becomes inconvenient for the system. That is not a conspiracy theory. That is recorded exchange history. But here's what most investors miss when they only look at 1980. The story of silver market structure did not end there. Fast forward to 2020, and JPMorgan Chase, one of the largest bullion banks in the world, agreed to pay nearly $1 billion to settle charges brought by the U.S. Department of Justice and the Commodity Futures Trading Commission. The charges involved a practice called spoofing, where traders place large orders they never intend to execute, just to move the price and then cancel them. Prosecutors said this activity occurred in the precious metals markets, including silver, for the better part of a decade. This is not a fringe claim from an internet forum. It is a matter of public record documented in Department of Justice press releases, and it is one of the largest market manipulation settlements in American financial history. It confirms that at least some price manipulation in silver markets was real, prosecuted, and admitted to as part of a deferred prosecution agreement. So now we have two confirmed facts. Silver is strategically important to defense manufacturing, and silver markets have, at least in documented cases, been subject to manipulation by major financial institutions. The theory that connects these two facts, that there is a deliberate, coordinated effort by the military-industrial complex specifically to suppress silver prices for defense procurement reasons, is where we move from documented history into speculation. No court case, no leaked document, and no regulatory finding has ever established that defense interests directed banks to manipulate silver prices. What we can say is that the incentive structure exists on paper, and that the market has a track record of being vulnerable to manipulation by parties with large enough positions and enough motivation. Whether those two things are connected is something you, as an investor, have to weigh using judgment, not proof. This is where everything changes for how you should think about the setup. Because regardless of who benefits or why, the physical supply and demand picture for silver has been shifting in a way that matters more to your decision-making than any theory ever could. Silver demand today comes from three major buckets: industrial use, which includes electronics and solar panel manufacturing; investment demand from coins and bars; and jewelry and silverware. Industrial demand has grown significantly over the past decade, largely driven by solar panel production, since silver paste is used in photovoltaic cells. The Silver Institute has reported that global silver demand has outpaced mine supply in multiple recent years, creating what analysts call a structural deficit. When a market runs persistent deficits, inventories draw down over time, and eventually that tightness tends to show up in price, unless something offsets it, like recycling, substitution, or, as some analysts argue, suppressed paper market pricing that doesn't reflect physical scarcity. Let me tell you about an investor named Daniel, who I'll use as a composite example to illustrate how people often misread this setup. Daniel started buying silver coins in 2019 because he'd read about the deficit and believed a supply squeeze was inevitable. He expected prices to move quickly. Instead, silver spent years grinding sideways and even fell during moments of financial stress, like March 2020, when liquidity crunches forced investors to sell even the assets they believed in just to raise cash. Daniel's mistake wasn't believing in the long-term supply story. His mistake was assuming that a real physical deficit translates into an immediate price reaction. Markets, especially heavily traded futures markets, can diverge from physical fundamentals for years. That divergence is exactly what fuels manipulation theories, because it's genuinely strange to watch a metal with tightening physical supply trade sideways or even fall. But strange price action doesn't prove a conspiracy. It can also simply reflect the reality that paper silver trading volume on exchanges like COMEX is many times larger than the actual physical silver mined each year, meaning price discovery happens mostly through contracts, not physical delivery. This gets at something every serious precious metals investor eventually has to grapple with: the difference between the paper price and the physical premium. When you go to buy actual silver coins or bars, you'll often notice the price you pay is higher than the quoted spot price. That gap is called the premium, and it tends to widen dramatically during periods of high demand or supply stress, like it did in 2020 when mints briefly ran out of inventory and premiums on silver eagles more than double the spot price. Watching that premium is one of the most practical things you can do as an investor, trying to understand whether physical scarcity is real, regardless of what the futures price says. If premiums are stable and low, physical supply is comfortable. If premiums spike while spot price stays flat, that's a signal worth paying attention to, because it suggests the paper and physical markets are telling two different stories. So what should you actually watch if you want to think about this critically instead of emotionally? First, keep an eye on the Silver Institute's annual World Silver Survey, which publishes mine supply, industrial demand, and inventory data. Second, track COMEX registered and eligible silver inventories, which show how much silver is actually available for delivery against futures contracts, a number that has fluctuated meaningfully over the past several years. Third, pay attention to premiums on physical silver from major dealers, since that's a real-time signal of retail and institutional appetite. Fourth, follow defense spending trends and solar manufacturing capacity announcements, since both are growing sources of industrial silver demand that don't care about investor sentiment. They simply need the metal to build things. None of these indicators will hand you a prediction. What they will do is help you separate documented fact from narrative, which is the single most valuable skill you can develop as a precious metals investor. It's worth being honest about the limits of this whole conversation, too. Defense Department budgets are public, but internal procurement strategy and any private communications with commodity trading desks generally are not, which means outside researchers are working with incomplete information. Claims that frame this as an organized top-down conspiracy tend to outrun the actual evidence. What the evidence does support is more modest but still important. Silver is strategically useful to defense and technology sectors. The market has a documented history of manipulation by financial institutions with profit motives, and physical supply has been running tighter than demand for years. Those three facts alone are enough to justify paying close attention to this metal, without needing to accept an unproven theory about coordinated suppression. What ties all of this together is a simple idea. Markets are shaped by incentives, and understanding who benefits from a given price level is always useful, even when you can't prove intent. Silver sits at an unusual crossroads of monetary history, industrial necessity, and financial market structure that most other commodities simply don't share. Whether or not there's a deliberate hand keeping the price down, the underlying supply and demand dynamics are real, documented, and worth understanding on their own merits. That, more than any theory, is what should guide how you think about this metal going forward. If this kind of research helps you look at the metals market differently, consider liking this video and subscribing to Gold and Silver Analysts, because we break down stories like this every week. And I'd genuinely like to know what you think. Drop a comment below and tell us whether you think the paper and physical silver markets are telling the same story or two very different ones.